Hey everyone, my stock portfolio is down over $6,000 in the last month alone. In this video, I'm going to go through three main reasons why my stock portfolio is down that much, go into some of those reasons, into some of those stocks, and why I am still not selling any of them. If you like this type of content, be sure to hit the thumbs up button. It really helps the channel a lot. And consider subscribing to the channel as well, as we're still a growing channel here. Okay, so overall, going to my portfolio here, I'll show you in the last month. In my Canadian side, I'm down about $4,700, as you can see. Just jumps off a cliff here over the last month or so. Going over to the US side of my portfolio, in the last month, I'm down about 2,000 US dollars. So overall, down $6,000 to $7,000 across my two accounts here. And as I scroll through, the biggest hurt that I've had across my account has been number one, real estate. So REITs across the market have gotten hit hard over the last month. Going to go into a couple of them here. You can see Allied here over the last month down 6%. This is an office REIT in Canada. Another REIT here down a bit less, but in the last month, Cap REIT is down over 6% as well. And as I just continue to go down, I have a lot of REITs. It's probably my highest weighting across my accounts, and lots of them are down pretty drastically. Trying to find another one here. Oh, my other one is in my USD account. Realty income here last month down 6% as well. So the sector is down pretty big. The thing about the REITs is it's not really the REITs specifically that I own. If I look at just REITs overall, this is the XRE ETF. The entire real estate sector is down over 3.5%. This REIT, or this ETF rather, holds lots of REITs from RioCan, Cap REIT, some other industrial REITs that have probably held up a bit better, Allied, some other retail REITs. So just the REIT sector as a whole going down over the last month has really hurt my portfolio, given the size of the positions within the REITs that I do own in that account. And that's been really hard to come back from on a short-term basis. My overall thoughts on the weakness in REITs is I think over time, REITs will do just fine. And actually, I think it's a great opportunity to invest in high-quality REITs at these lower valuations, these lower multiples. REITs like Realty Income, REITs like RioCan in Canada. Cap REIT's a great one as well. As interest rates go down, their multiples should expand. Their cost of doing business, or in terms of the interest they pay, will go down, which will expand funds from operations as well. So I think there's exponential growth opportunities in a scenario where the economy or the interest rates do go down. So really not too fussed. If you own like lower quality REITs who had very high debt levels, then maybe there's risk that the short-term environment could completely wipe out the equity. But for the most part, I feel like the REITs I'm invested in are pretty well capitalized, have reasonable debt to equity ratios, continue to have relatively strong performance in terms of occupancy levels and whatnot. And I'm just being able to buy in for the long term at lower valuations, higher yields, getting 5.3% here on Realty Income, for example. I'd say probably my most risky REIT that I do own is Allied Properties, which I showed you off the bat. This is an office REIT, but I feel like even though riskier, the risk reward is definitely there. I'm getting an 8.7% dividend yield to weight. This stock over the last year is down about 40%. They do about $2.20 of funds from operations. So trading at about 9.5 times current year funds from operations. And they are, even on top of that 9 times funds from operations, investing a lot in new development projects, downtown Toronto and other cities. So that should go up as they get occupancy, turn those into revenue producing assets. So big first bucket, and honestly the main reason why specifically my Canadian side here is down almost $5,000 in the last month is the REIT exposure of my account. The second big reason that my stocks are down, or my stock portfolio is down this month, is utility companies. So you see here, Canadian utilities, in the last month, down about 5%. This stock here pays a pretty nice dividend, 5.5%. I'm down all time about 7% though. So looking at this one over the 5 years, it hasn't really gone anywhere, but you have gotten a nice dividend over that time frame. You see the dip that I've gotten throughout this year, down from $39 down to $32, but specifically in the last month here, it's been pretty rough. The other utility company that I own, regulated utility, is Fortis, and this is usually a really stable company, down about 3.5% here in the last month. And I think there's a couple reasons why these stocks are down. The first reason is interest rates. So as interest rates continue to go up, and the outlook for interest rates a couple months ago looked like it was stabling out, potentially going to hold or start going down aggressively or moderately at least, which would increase the multiples of utilities since they're very bond-like in nature. But the recent sentiment with some recent inflation reports is that they're going to hold or potentially go up more. So I think that's a big reason why my utility stocks have been going down. The other one, and more specific to the sector, has really been the wildfires in Maui. So the report here, Hawaii Electric stock plunge, raises climate change concerns for utilities. So other utility companies are concerned that similar things can happen to them, especially a company like Fortis, who operates assets in the Caribbean or other areas like that may be more susceptible to climate change events. You see what happened for Hawaiian Electric over the last month, down 70%. So it could be worse. I could be invested in this company, which may have some liability issues with the wildfires in Maui, given the amount of electricity and everything else that can trigger fires or get pushed over the top with high winds or certain weather events. So I think there's some carryover effect, obviously not minus 70% across utilities, but that paired with the interest rate increases is probably, or the narrative around interest rates potentially increasing, is probably responsible for lots of the dip in these assets. For me personally, I think these companies are super stable, provide really good cash flow. Fortis, for example, raises their dividend about 6% each year, currently giving a 4.1% yield. And they've just been extraordinarily stable. I'll look over here because it gives an even longer term view. But Fortis over the long term has just done a phenomenal job of paying consistent dividends at the same time of investing in their regulated base of utilities to grow tremendous shareholder value. So even if I just look in 2010, the stock was trading for $26. So they've paid a 4% give or take dividend throughout this entire path over the last 13 years, and also doubled the value of the equity. So I think over the long term, they have the business model set up. I think climate change events could impact utilities for sure. They could also impact almost any other business if you want to find a way to tie it in. For example, CN Rail, just off the top of my head, is one of my top holdings. It's a physical infrastructure with floods, with fire, stuff like that. It could pause their ability to operate in certain regions. It can make them rebuild tracks, but we haven't really seen their stock get hit over the last month because of increased weather concerns or climate change concerns. So I think it's just wrong place, wrong time for this industry, given the events that took place in Hawaii, and they may be getting a bit of a disproportionate haircut. Not a reason personally, in my opinion, for me to sell out of any of my two utility stocks that I do hold. They pay me really good quarterly dividends, and I'm looking forward to keeping them in the portfolio. If they keep going down further, it may even be a bit of a buying opportunity. And the third bucket of why my portfolio is down so much in the last month is just a couple specific stocks having unique equity valuation changes. The first one is Rogers Communication. So in the last month, this one is down about 8.5% here. So not doing very well. They just acquired Shaw Corporation. And I think one of the biggest things is the amount of debt that they released on their quarterly earnings. So you see here, before COVID, they had $12 billion of debt. went up to $13 billion of debt during COVID. Then, as they prep to buy the Shaw deal, primarily with debt, they raised another $10 billion and now another $5 billion. So they've gone from, they essentially doubled their debt over a 3 or 4 year term at a time that interest rates are extremely high and have been increasing as they've been doing this. So they probably didn't know exactly what they were signing up for in terms of cost of capital here, or at least long term after the initial agreements or initial loan contracts expire. So they have a really big uphill battle to pay down lots of this debt. They reported okay operating results for the first quarter, or their first quarter with the companies merged. But I think there's a lot of concern on the debt load that they've taken on relative to their market cap and their annual cash flow, and how fast or not fast they're going to be able to deleverage and get back to good debt to equity or debt to EBITDA ratios that they were at prior. The second stock here that's taken a bit of a dip last month is Meta. And Meta is a stock that has actually performed extremely well for me over the last year, obviously. So going into Meta, I'm up 180% on this one. It's going down by the minute now, 178. But if I look at the stock over the last month, it's down about 6.5% here. So on my overall position here, 6.5% is a couple $100 just on Meta. I think Rogers being down 8% was about $500 down for my entire portfolio on that one. But this stock here down almost 7% in the last month after being up 18% in the last 3 months despite that dip. So before that, they were probably up closer to 25% on the quarter. In the last year, up 66%. So this one's performed well for me over the last year, but I think it's just a bit of a cooling off period, a bit of a correction as they have just rallied so aggressively. Year to date, this one's up 133%. So they've gone from $325 down 10% from the peak to $291 here today. So not anything I'm overly worried about, because it's just in the grand scheme of things, not a big deal given the volatility that this one has had to the upside over the last year. But it has definitely had an impact on my US holdings throughout the last month. So those are the three things over the last month. Number one, real estate. Number two, my utility holdings. And then number three, just some unique situations with a couple of my relatively big positions across my accounts, which is the reason why I'm down over $6,000 total in the last month. I'm not too concerned. I think fundamentally each of these businesses are still doing fine, and if anything could be a good buying opportunities if these issues and these devaluations persist. Currently up about 7% overall in my portfolio. Used to be up closer to 10-11% I believe a month ago, but looking forward to continuing to build the portfolio regardless of the dip that we've had here over the last month. If you like this type of content, be sure to subscribe to the channel. Consider liking this video as well. It really does help with the YouTube algorithm, the more people that like these videos. So I'll just give you a second to do that, and I will see you guys in the next one. Thank you.